John says, there was a trade I wanted to get your feedback on JPM. Long put Butterfly, September 17th. And you gave me 2 examples. Okay. Well, first off, I'm going to say I do not trade butterfly positions, John, whether they be long butterflies, long call butterflies, long put butterflies, or iron butterflies. Not in my wheelhouse, not a strategy that I like to trade. And I'll tell you why in a moment, but you probably already know why. The risk reward looks great up front. And the ideas of managing it look potentially possible going up front, but it's a lot of effort. And normally during the day, we're creating webinars, we're doing coaching sessions, we're doing other things. I do not have the time to implement butterfly positions and watch them, even if they're out to September. You're going out to September, you're not trying to do weeklies, that's fine. But what are we doing here? We're doing a 160, your first example, a 165, 155 at the money with the 145. What are we doing here on this butterfly? We're going to sell 2 155 puts, buy a deep in the money 165 put, and buy an out of the money 145. Standard 2 to 1. Let's keep it that way. Okay. All right. So sell 2, buy 1, buy 1. This is going to be a debit. An all call or all put butterfly is typically done at a debit. Okay. And we're looking at a debit of 417, 418. Potential to make 582 here. Stocks at 154, upper break even at 160 at expiration, lower break even at 149, about 5 points, 20 cents in each direction. Now, why do I say that this requires management? No one I know, no investor I've ever talked to since I started working with power options in whatever it was, 2001, 2002, for example, 2002, 2003. No one I know that I've talked to over the years ever trades a butterfly with the expectation of this occurring. That's not realistic. All right. So we saw that we could have a 41% return in this case. You've got a debit of 14. The margin requirement is 14. You've got a debit of 417, but you've got to cover the margin requirement of this bull put credit spread. So total outlay of capital at 1417 to make a max profit of 582. No one who trades a butterfly expects the stock to stay exactly where it is and make this maximum profit anytime or anytime soon. If it's 1 week out, if it's 2 weeks out, if it's 1 month out, they're not expecting it. This occurs less than probably 1% of the time for butterfly traders. What are they constantly doing? They're constantly moving the short call in an iron butterfly or the short put in an iron butterfly that becomes in the money. They're moving one of these spreads to create now sort of more of like an all put Condor, or converting it to 2 bull put credit spreads if the stock starts moving up significantly in this direction. There's consistent management. There's management to make sure that the deltas are even, because as this starts going up, this is losing delta. This is losing delta. Of course, this is losing delta, but you've got 2 of these. And if it falls, of course, then you've got to manage, maybe roll this down a little bit to try to stay delta or gamma neutral if that's your approach and the scenario involved. No one really expects to ever make the maximum profit. They're constantly shifting the whole spread, shifting one side of the spread or not. Let's just get to your direct question, John, without my thoughts on it, because if you like the butterfly, that's great. And if you're going to trade them that way, that's great. So what are we looking at here? You're looking at a risk of 1417. That's with the margin requirement. Okay, so the total outlay, your debit, and the margin requirement for the bull put side. And you're looking at a max profit of 582 with a potential of a 41% return, and your upper and lower BEs are only 5 points of 6. I'll give you 6. I'm just jotting that down at 6. And I'm not going to look at delta ratio or gamma ratio on this one versus the other one. We're not going to get that deep. So your second one was or going a little bit with an expected movement in this case. You have a specific sentiment in this case, same expiration into September, but doing the 155, 2 145s, which are OTM, and 1 135, which is deeper OTM. What is this going to do? This is just going to skew the position to a sentiment, whether you're bullish or bearish. Okay? And so what this is going to do for you in that case lower total requirement, higher potential return, but a much lower probability of the stock being in a profitable range by itself. What do I mean by that? Well, of course, you're seeing a higher potential return, 65 versus 41. You're seeing a lower debit margin requirement, 12.10 versus 14.15, 14.17. And of course, lower maximum risk as well, too. I should have brought that up. Yes, but your lower maximum risk here of only 2.10 on this spread. But it's a lower probability of getting into the range of the position. But it's just my concern, and don't know many who have been successful consistently with these positions over time without effective management. And if you're expecting a rocky road, if you're expecting a bearish road, bearish trend, you're skewing it to a bearish side, John. I get that. That's what you're doing, and that's fine. You're targeting a lower cost in JPM 145 going into September as the market pulls back. Things globally still are things globally. The economy, not sure how we're going to recover, what the sentiment is. We all know what's going on out there. It's too much to talk about in one webinar. In any case, the two graphs sort of side by side. You're at a 155 with a max potential of 528, roughly here, with the 145. Okay, and that had a higher maximum risk in the 165. Okay, so those sort of are two charts there. And you know your break-evens were 164, did I say? It was, oh yeah, it was about 5 or 6 points. Okay, so it was 164-ish, I think, here was your break-even. Kind of drew that wrong, and then it was 149, if I'm not mistaken, on the break-evens. Your stock's right here. So what happens if the stock drops down to 148, 147? Well, you'll be at a loss at position 1, but you'll be in a profitish zone here or here at expiration. That's good. What if it moves up? Well, here you're still in a good zone. Here you're starting to get in the red zone on the skewed position. Now it becomes tricky. This is what worries me about the picking the skewed position one side or the other, David, with a butterfly, with a short straddle, a short strangle even. When you try to skew it one direction there, or an iron condor. You can even skew an iron condor by going only, let's say, 1% out of the money with the bull put side, but 4% out of the money on the bear call side, or reverse. To pick a bearish one, I'd go 1% out on the bear call and 4% out on the bull put. If you're wrong, you don't got a lot of window here. You're already above the upper break even for this position. Yes, I know that's at expiration, but look at even at the halfway point. At the halfway point at 9.6, halfway between now and September expiration, you're still starting off in a loss zone. You always start off in a loss because you have to liquidate. But if the stock starts to creep up, if some good news about the economy comes up and it starts to creep up to 160, you know that's your risk. Now you've got to decide how you want to manage it. And now that becomes tricky. Because if you want to manage it to get out of the loss side, to move this back up to maybe where you were at the money, let's say the stock goes to 160 and now you do the 155 and the 145 in this case, actually it'd be a higher risk with a lower return like that if you had to roll it, because you're going to take a loss on this one and that's going to cut away from the gain on the next one. And of course, now the stock reverts back and now you've got to move it back down. You're just lowering your profit each time. Of course, you could wait it out and say, hey, all I'm losing on this is the value of this bear put debit spread as the stock's moving up. I'm winning on the bull put. I'm losing on the bear put. Maybe I just have to adjust this as the stock continues to move up in price. But whipsaw effect going back and forth, how often are you going to adjust it? Or are you just going to hold on hoping that as you get closer to September expiration, the time value decays out, you're back near your target? By raw numbers of profitability and cost, this second one looks better. By expectations of expectancy of profit and probability, this one is worse. That's the simple definition. The at the money one gives you a better profitability range from where the stock is now. Think of think of volatility cones you sometimes see, John, and things of that nature. You've got a better potential success rate being right at the money in that scenario with the 155s. As the stock moves up and down, you're not as concerned that you're entering into a loss. Here, you're starting to go into a loss right away if it moves in a direction you didn't anticipate and starts moving up. It needs to move down to get into that mild profitability range where most butterfly investors expect. They're never expecting this because each time you manage it, you're twinkling this down. You're trying to stay in this hot zone here, but the sweet spot's probably right somewhere in here. Had an older webinar, that I mentioned, and we did some testing. We did back testing in different market conditions. And if you just put the butterfly on and left it alone, what we typically saw is that less than 1% of the time, you saw this profit between 1 to 1.5% of the max profit. 10% of the time, maybe you were here. About 20% of the time, this is without management, 20% of the time you were here. Somewhere in the range of 40% of the time you were here. 20% of the time you were here. Sorry, these aren't the exact numbers we did, but I just, it's something like a Christmas tree here. Sorry, 20, 40. Yeah, and then another 10 to 15% of the time you're here at the maximum loss. And in big moves, it flips. This becomes 20. This becomes 10. This becomes 5. This becomes 10. And this becomes whatever's left, 35 or 40. I think it's 35 or 30. I'm sorry, 20, 30, 40, 45. Oh, yeah, it's much higher. Yeah, it's 50. It's about 50%. That's what we would see in volatile markets. And so management. It doesn't matter if you're doing an iron butterfly. It doesn't matter if you're doing the debit long put butterfly, the debit long call butterfly. That's sort of that Christmas tree expectation that you expect with the butterflies. They have to be managed, but every time you manage it, you're typically lowering the max price when moving to a new strike up or down because you're paying a debit to close this and you're not getting as much of a bang for your buck back because the premiums are going lower. Now you may have to roll it to October. You may have to go up to November to increase the peak. But now you're giving yourself so much more time for the stock to keep fluctuating against you. But again, my thoughts on it, not everyone's thoughts on it. I know there are successful butterfly traders out there. I have a few customers, maybe 3%, 5%, that trade butterflies on power options that I've talked to on a consistent basis over the years for coaching sessions, John, emails, things of that nature. I've had customers abandon it because they don't want to put the time in, just like I don't want to put the time in to constantly manage the positions. But again, your direct approach. Skewed butterfly, you're skewing bullish, you're skewing bearish. You're going to see a lower cost, lower debit, still same margin, but you're seeing a lower debit to do it. You're going to have a lower maximum risk, a higher potential max profit, but the expectancy of getting into that target zone is lower because the stock needs to move before it hits. The at the money, you have a higher cost, lower profit, and lower percent return, but a better probability and expectancy of staying within the sweet zone there for profitability with the less amount of management depending on market conditions. And that's my thoughts on your two butterfly comparisons and the all put or all call butterfly or iron butterfly in general. As many of you have heard me say, I haven't traded an iron condor since probably about 2017, 2016. Let me just go to SPY here. And the reason why is because when we were looking at different things and we were developing concepts related to bull put credit spreads, the market just started to take off. We were in a very strong bull market. 2018 was a little bit of a horrendousness, and we know what happened in 2020. But going back, so let me just go back 5 years. Going back to that end of 2015, 2016 was the start of that bull run up to 2017. Yeah, a little hiccup here. This was 2018, I believe, and the first part of 2018. And then we came up and we had that little dip again. This was the end of 2018, that horrific, the October, November, December of 2018. That's what we were looking at there. So, the 2016, 2017, little hiccup at the beginning of 2018, that decline. I think this was the end of 2018 I was referring to down here. And then 2019, fantastic. And then we knew what happened in 2020, and then little hiccups here, and then moving up. So this is why I haven't been doing butterflies. I haven't even considered them because they're not my style, or iron condors, because we were looking at evaluations. Yeah, you still lost on the bull puts here, and if you traded them here because you didn't follow the warning signs, or here, and of course, didn't follow the warning signs and try to keep trading them here. But you're getting stopped out on about 40 to 50% of the bear calls during this run, about 25% of the bear calls during this run, 30% on this run and about 50% of the time on the bear calls on this run, and about 60% of the weekly or 2-week out bear calls during this run, and about 50% here. This wasn't doing it. You'd have to skew it so where you're going 8-9% out of the money on the bear call, well, not that much, okay, 7-8% out of the money on the bear call side, and still being able to only go 3 or 4% on the bull put side. Yeah, there are hiccups there where the bull puts got hurt that the extra premium would have helped, but this wasn't the time. This was not the time for neutral positions longer term, going 1 month out, maybe even 3 weeks out or 2 months out in time. Didn't want to be doing necessarily neutral positions in this time frame at all. But then we go back and we look at the last 6 months. We look back to the year to date, to the beginning of January, now 8 months, with the expectations of a few good, strong runs. Really, this one and maybe a little bit of this one. This is more of a gradual trend where in the last 6 to 8 months, especially in the last few months, it's still going up. I understand that. But it's this melt up, pull back, melt up. And this would have been a better time frame for that iron condor or those butterflies. My concern is with the fear of choppiness going forward, with still a bullish outlook, but choppiness going forward and more volatility, these two strategies might be harder to manage and trade because you're going to be hitting your trigger points on a more effective basis. I'm not saying they're going to be better than bull puts. What I'm saying is that year to date, the last 6 to 8 months or so would have been a good time for the iron condors. Yes, you still would have got hurt here as you did with the bull puts. There might have been a timer here to manage the bear calls, but overall, it wasn't that. And then it's been more of a gradual, just sort of melting up and then coming down and then melting up and coming down, which is essentially the perfect time for those neutral positions. It hasn't been that for a few years, in my opinion. That's why I don't look at them too often, John, to wrap up that conversation there about butterflies, condors, and neutral positions. All right. Well, ladies and gentlemen, we are now at about 5:58 p.m. Eastern Time. We handled all the questions. I just want to remind you that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. I'm not opening a butterfly on JPM. I'm not personally not opening a spread that we looked at or a naked put on Kohl's or Ally Financial, for example, and any of the other positions that we looked at as well. Options do involve risk, as we discussed a little bit today, may not be suitable for all investors. If you like the tools you saw today, we reviewed the search. We spent some time in the portfolio for that great help to evaluate rollout opportunities for you in various strategies. The stock repair tool, even great tools for investors. Remember, you can take a 14-day free trial at any time. Just go to powerup.com, put in your name and email address, and you have full access to the site for 14 days. No credit card is required. After that, the subscription levels start at just $45 per month. Most popular service by our investors is the delayed service, about 15-minute delayed data runs. Gives you access to all of the tools, of course, except for the back testing. You can upgrade to that for only $35 more. $100 per month gives you everything in the delayed service with full back testing capabilities that we offer for the search tools and the various strategies, historical options chains, and, of course, the historical search by symbol. And that's, $100 per month. And, of course, we do offer a real-time service. And the whole kit and caboodle in the premium service, that includes everything. Well, we tried today to serve some of the education, but remember, you can take a look at any of our archive webinars at any time. Just go to poweropt.com and click on the free webinars link, and you can scroll through the different ones. Some of those are not open to non-subscribers or non-trial members, but you can also get a wealth of information over on our YouTube channel. Just find Power Options on YouTube. Go to the videos link and search, as we showed before, for rolling naked puts, rolling other positions. You'll find a wealth of information there, different presentations linked to your content. And of course, if you have any other questions, send me an email at any time to support@poweropt.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, trial members and subscribers can schedule a free coaching session at any time. It's essentially a 45 to 50-minute phone conversation with myself or Ernie. We walk you through the tools on the site and answer any questions that you have.